slides because it's important to know why the concept of venture capital is important. So it's very important to start focusing on supporting businesses at a very early stage of their growth. And a typical startup venture financing life cycle starts from an ideation stage, an exploration stage, and you have your typical Series A, Series B, C stage, and then eventually to either a trade sale or an IPO or exit. Like, I'm sure you're familiar with these stages of investments, right?
Yes.
And then the slide after that talks about how an ecosystem sustains itself. So when you're at the concept stage or seed stage, you're typically funded either by yourself, what people normally call bootstrapping, friends, family, and fools, and angel investors, etc. I'm sure you guys know what these terms are. Once you go beyond the seed stage, that's when you typically get money from venture capital funds. I'm not going to explain what VC funds are. I'm assuming most of you know what these things are. And then once you get into Series B and C is when you talk to private equity and late stage VCs. In the States, for example, I'm pretty sure all of you have heard of funds like Sequoia and Manhattan Ventures and Accel and Kleiner Perkins. These are some of the funds that funded Facebook, Google, LinkedIn, etc. And then you typically have your trade sales and IPOs. Now, in less mature markets like South Africa or Turkey or Eastern Europe, for example, you tend to have a lot of investment at the angel stage, which is your concept MVP stage. You have a lot of involvement in the private equity markets, which is when companies are profitable, mature, and cash flow, have stable cash flows. But there is a missing middle in the venture capital space. And venture capital, from a conventional perspective, means companies that need to raise anywhere from $500,000 to about $5 million worth of funding to fund growth, right? Which we typically call your Series A and Series B stage. On the entire African continent, the average amount of money invested in venture capital per year is shockingly low. It was as low as $12 million in 2013, pure venture capital, and now it's up to about $100 million. So it's quite low. But the reason for that is you need to have a mature, self-sustaining ecosystem where if you have an idea and are funded by seed investors, you need to have a certain pool of risk capital that invests at the VC stage, because they know that you have the opportunity to get significant traction and can be either sold to or raise money from private equity and can start paying dividends in 4 or 5 years. Otherwise, that missing middle does not exist. So, the next slide